We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. So welcome to the podcast, Anna, Mike, Rob. Excited to have you here. But before we get started, for the benefit of our listeners and viewers who may not be familiar with you and your work, do you mind giving us a brief overview? Let's start with you, Anna.
Thank you, Bob. I'm Anna Rappaport. I'm an actuary completing 60 years as a fellow of the Society of Actuaries. That's 60 this year. And a phased retiree. I chair the Committee on Post-Retirement Needs and Risks for the Society of Actuaries, and I'm a past president and have been involved in many, many research projects related to retirement.
Rob, how about you?
Thanks for inviting me here, Bob. Rob Austin. I'm from Alight Solutions. I head up research at Alight Solutions. We are a record keeper, so I look at what participants are doing within 401k plans and what employers are offering within them.
And Mike?
Yes, thanks, Bob. Good to be here. Michael Doshier, T. Rowe Price, Senior Retirement Strategist. So basically, organize a lot of our research at the participant, plan sponsor, and advisor level inside the firm, and actually represent the organization as a spokesperson and thought leader on the outside.
So this is designed to be a roundtable discussion of retirement topics that the Retirement Management Journal Editorial Advisory Board developed, and all three of you are on that board. So these topics should be somewhat familiar to you since we talked about them in a board call already. But we have 7 topics that we've identified as the most important to discuss, and the first of which is the retiree behavior and spending patterns. Anna, let's start with you. What do you have to say about that topic?
I have a few things to start us off with. First, as we think about retiree behavior, as professionals, we're all thinking about people doing long-term planning, but our Society of Actuaries research repeatedly has shown that many people aren't doing long-term planning. Rather, they're doing short-term planning, and they're planning based on expected cash flows, which means they know they're going to get their Social Security check or any other regular income. They know they're going to pay their insurance premium every month, but they don't know about the dental care they're going to have. So they're planning more for expected expenses and short-term, and both of those are really big gaps. When we've asked about different risks in some of the focus groups we've done over the years, we've tended to get answers like, I'll deal with it when it happens. Not always, but too often. So those are really big challenges. We've also repeatedly asked people about spending down their assets and what they might want to do. And it seems that many people would rather reduce spending and not spend down their assets. They say, I want to keep my assets and I'd rather reduce spending. They're very frugal. Also in line with all of this is that household spending tends to decline with age, and housing is the biggest, and often people don't realize it. Housing is the biggest element of spending and often the biggest piece of assets in all the retiree age groups. And people say, well, people that own their houses, they don't have a lot of money to spend on housing, but taxes have gone way up in a lot of areas. Insurance has gone way up in a lot of areas. There's still maintenance, which is unexpected. So housing is really important, and it's become, so as a sort of a side thing, it's become very intertwined with climate change. Big planning problem about housing is people often have too much of their money in their house, and they don't think about it. When they think about their asset mix, they don't think about how does the house fit in and keeping it reasonable.
Yeah. So what are the, yeah, those are really good points. So 2 things. One is, Mike, for you, because T. Rowe Price just put out a study about lumpy spending that Sudipto Banerjee published. And I'm curious, given what Anna just said, what your view is on retiree spending, given that some of it may be lumpy.
Yeah, well, nothing could be more true, Bob. I think just about everything Anna said, our research absolutely aligns with it. The old, whether we jump ahead and talk about the 4% rule, whatever rule you want to apply, the fact that you're applying it in some kind of, utopian world of smoothness is so far from reality, right? I mean, we are finding that spending is very lumpy. There is, in general, a downward trend throughout the lifetime someone's retired. It looks like our research, the stuff that you mentioned that Sedipto has done, shows about a 2% degradation year over year on average, right? It's not like it's some smooth number, but on average, it drops about 2%. And the lumpiness of that spending is significant. And the biggest area where the lumpiness can show up is what Anna just talked about, which is housing, right? I mean, if you look at, especially as the age groups, we broke them down between 55 to 64, 65 to 74, and 75 plus. That number becomes even more significant as people get older, right? So their other spending might decline, but to Anna's point, inflation impacts on things like insurance, taxes continue to drive that up, and that is the biggest source of ongoing expenses and the volatility of expenses because of those changes that people really hadn't predicted.
If I could just interrupt for a minute, I think this really tells a big story that's important for you, which is planners really need to be able to help incorporate housing into the way they plan and into the spending and into asset mix and strategies for using that money if people have to use it.
Wholeheartedly agree with everything that's been said here. I mean, so we find from our data that the only exception to the lumpiness is in two camps. One is there's a lot of people that will take their money out right away, right? And I've seen things like it's up to 40% of people are relying solely on Social Security for retirement. But when we look at people that kind of keep their 401k plans and their balances in them, there is a very, very large swath that just relies solely on the minimum required distributions and just taking that out. And so that's what we see from ours is that there's a lot of people that are doing that. Now, is that optimal? Is that suboptimal? I think it's people trying to say, you know what, I don't really know what I should be taking out of this. And somebody else has kind of made the decision already for me. It's a requirement. This is what we have. And now I'm gonna take it. Now, of course, we don't know where that money's going once they take it out of the plan. And so it could very well be that they're putting that into a bank account or something else that are then using for some of the more inconsistent spendings that you addressed, Anna and Michael.
Some of our focus groups, we talked with people about that. And one of the things is because the RMD is required, some people don't view that as taking money out of their assets.
Yes. Yeah.
I know that sounds strange.
Yeah. So when I think about retirement income planning, I really think about it as a spreadsheet, right? It's about rows and columns and filling each cell. And when I think about how complex it can be, the current off-the-shelf software programs don't seem to accommodate the decline in spending, the lumpiness. They advocate for systematic withdrawals, where you might use an inflation-adjusted basis to create higher and higher income streams. And it seems like what planners are using is really inconsistent with what real people do in life. But maybe, Rob, you could elaborate on that.
Yeah, I mean, I think part of that is because it's really tough to know how many rows or columns you're going to put into that spreadsheet, right? I mean, like when it comes time for how do you actually want to draw down the money, you're faced with some questions that are really difficult. I mean, the first one is how long are you going to live? And Anna, you said you're an actuary, and I'm an actuary by background. I mean, we might be able to predict some things for people over the masses, but for an individual, it becomes really, really tough. And obviously, that's something you don't want to necessarily get wrong, because if you're planned on saying you're going to spend till you're 80 and you live to 85, that doesn't really help you out all that much. And so I think it gets to be really, really complex to fold in all the different variables. But I think, sometimes some of the software, you kind of just have to come up with something. Michael, I know you addressed the 4% rule before, right? That is clearly wrong. I mean, nobody ever uses the 4% rule, but it's no different than, say, like a target date fund when people are accumulating money. Like, people don't really retire as soon as they turn 65 and immediately start spending their money. It doesn't work that way. But it's something to kind of go off of. But that's my viewpoint, Michael. I mean, like, from yours, the 4% rule and the software, what would you say?
Yeah, so I think you have to think about the perspective of the client in question here, right? So let's look through at the investor, the participant in a 401k plan. We're finding there's kind of two frames of reference. There are people that are much more set to the actual income that gets derived off of their investments, and there's other people that are more pegged to the actual account balance, right? So the latter is not surprising, and we think it's somewhere between a third and half the population that over 40 years they've watched their balances go up. When it's time to retire and live on those assets, some people have a hard time unwinding those learned behaviors of constantly watching the balance, and that becomes their primary driver. There's another group of people that we think is a half to about 2/3 of the participants, and that is people that are going to be managed by the context set by the investment products that they are given. Whether it's the R&D or it's something more specifically designed to a product, but if they buy a managed payout that targets a 4 to 6% payout range, they're going to modify their lifestyle to fit the 4 to 6% payout range because that's the paycheck replacement in retirement. Even if they could afford, based on their personal goals, to spend more if they're trying to arrive at a asset depletion at the end of life and not bequeath anything to the next generation, they might not do that because the context set up by the product and the investment that they're in often leads them to believe that's what I derive as far as my quote unquote income without it being perceived as spend down. And I think that has some implications to Anna's point earlier, where I think a lot of people see R&Ds as, well, that's the income coming from my retirement savings. It's not like I'm going in and, depleting my assets.
Michael, the economists would say that those folks have it all wrong, that the ideal is to have maximum utility throughout your life. And obviously they're cutting short their utility if that's what they're doing.
Absolutely. And the conflict in their mind gets more on the emotional side, right? Because they get some level of personal satisfaction, or maybe it's even more deep than that. Maybe it's the staying away from unnecessary anxiety over the fact that they see that balance. It's something they've been able to measure and track over the years, and that makes them feel good. So that trade-off's worth it to them from an emotional justification perspective.
What about you, Anna?
There are a couple of there's some more things about that as well. One thing is that for people who don't have a lot of long-term care insurance, for some of them, it's also a way to do a way of, if I need the money because I get sick, it's that. And it's also potentially an inheritance. The Society of Actuaries just sponsored a conjoint analysis study where Deloitte did the work on it, on what plan provisions, what retirement plan features people would really like. And one of the things that showed up there was, again, that people wanted to hold on to their balances and the spending less than they could. The same thing has occurred not just in the U.S., but in the U.K. and in Australia. So there really seems to be people having more of a wanting to hold on to their money and leave money to others, as well as protecting against possible long-term care risk. And then, of course, the other thing is a lot of them don't plan long-term. Wanted to mention one other thing about software is there is so much software out there, and I think it's really hard for people to know what to use. Society of Actuaries, we did a project called Retirement Planning Tools, and it doesn't look at specific software, and software changes every day anyway, what you can get, but it sets up 3 categories, sort of simple, moderate, and more sophisticated, and it tells people, if you get simple software, expect to input about this much stuff, expect to get out about this much stuff, and you could use it to answer these questions. It does the same thing for moderate and more advanced, and it also provides some hints about how do I tell if this looks like reasonable quality software, because some of it's good and some of it, frankly, isn't.
I mean, it seems like, with respect, I mean, it's sort of a necessary evil, right? We have this retirement planning software that FAs use. It's not entirely adequate, and nor does it account for all the things that we've just discussed, right? So, but it's better than nothing, I suppose, right? and it's far easier than someone customizing a spreadsheet, even though that might be the best thing.
Well, yeah, if I could, I'd like to add 2 things on both things Anna said. I'll start with the software first, and then back up to the comments she made about long-term healthcare. On the software, I think, Anna, one point you made, things change almost by the minute and by the day. There's big name brands that have been out there for decades that a lot of advisors have built habits around that I think of the old adage, go west, young man, show how old I am by talking about that when I heard when I was a kid. I think all of them get you going west, right? And I think some of the ones that have been around for a while can probably get you as specific as California, right? But there's some new ones out there now that really do. I think, if you want to go to the South Bay area of San Francisco, they'll get you there, right? I mean, they're not as widespread in their deployment yet as some of the bigger, broader ones. But I do believe we're on the cutting edge of some, whether you're talking Social Security and tax optimization and asset location, all of that stuff. I do believe that the latest tools are beginning to turn a corner on being more useful. So that's on the software side. On the healthcare shock, I'll call it, because Bob, you already made reference right at the outset of the lumpiness research we did. Absolutely spot on with what Anna said. People are holding on in case they get some kind of healthcare shock expense. The good news we found in that research is over any 2-year period, the average healthcare shock we found was $8,000. You had to go all the way to the 95th percentile to get to those eye-popping, like $50,000 plus expenses. So that's good news, right? And as we looked at the distribution, 78% of people we talked to had healthcare expenses over that 2-year period of less than $2,000. 78% less than $2,000. To get into that kind of $25,000 plus kind of horror stories we all hear and plan for, it was less than 2% of the population. So
you're talking about acute health care and not long-term care, or both?
Yeah, sorry. I'm talking about more acute healthcare and shock systems that shock you from a cash flow standpoint.
So we have a lot of ground to cover. As I said at the outset, there's been an increasing amount of debt that older Americans are carrying on their balance sheet these days, whether it's student loans, mortgages, home equity, et cetera, credit cards, auto loans, on and on and on. Michael, any thoughts about that?
Actually, like, you could give me a second on that one, Bob, if anybody else has a more front of mind opinion. I just read some fresh research we did on the level of debt, so I'll give me a second. I'll come back.
All right, Rob, Anna?
Well, I've got a couple of things to say. First of all, this can really be a barrier to people saving for retirement, debt, and difficulty with debt. And think about the financially fragile people who aren't necessarily, a lot of them are low income, but they might just be high debt compared to their income. So we really need to worry about that, not just at retirement, but then before. There's a lot of different perspectives about paying off mortgages. And I think, again, that's an important thing for an advisor to help people think about the pros and cons. The other thing I'd say about debt is that we talk about debt sometimes like it's bad and sometimes no, but it's both. Because mortgages, student loans, if they're used well, they help us build our life better. But they need to be used well and not too much. But then credit card debt, payday loans, there we're getting into major problems. And you can say, well, that's not about retirement, but it's sure a barrier to retirement. So the more we can do to keep people out of the bad space and keep things in control, the better.
Yeah, I agree with you on that one, Anna. I mean, like, I think part of the psyche behind it, though, is people might feel like credit card debt, it is a good thing for them because they're able to show what they spent their money on. But if you think about credit cards just kind of like over the history, so people that are kind of just entering their retirement ages right now, right? So people that are kind of maybe in the 60s, they were probably born in the 60s, right? And so they were kind of really coming into their own in the 90s. And in the 1990s, credit card solicitations increased fivefold. Right. And so during this period of time when people were establishing the kind of their spending habits, they're getting inundated with all these credit card solicitations. And that really kind of increased the credit card debt that people were carrying. And to your point, Anna, yes, it was something that hindered retirement. Fortunately, there were things like automatic enrollment and other parts that kind of had people kind of doing this but by default. And so you kind of had this simultaneous saving for retirement while there was also increasing the credit card debt. Well, now, of course, you have a balance that really hasn't kept up with the credit card inflation. And so that's what's really caused a huge part. So now people have to pay this off, add in increased interest rates, and all of a sudden it's gone even higher. And so it's a treadmill that's going faster than the person can run.
And you have to understand, when Rob says automatic enrollment, he's only talking about those people that have decent employer plans.
And that's a good point.
And there's a lot of other people that don't have them.
Absolutely. You're right.
And I'll come back now around Bob. The research we did runs a little counter to some of the things we're hearing right here, right now on a couple of things. Let me see if I can be clear about that. So we just did this research. It came out of the field like less than 30 days ago. The percent of retirees that claim they're retiring with outstanding credit card debt has been dropping actually since the beginning of the pandemic. I think there's some commentary that it might have bottomed out and might be starting to head back up, but we haven't seen that in this research. So right now we're seeing, as of 2023, 29% of new retirees heading off into retirement with credit card debt. The average account balance has been somewhat static around the $2,000 range. But when asked the sources of emergency funding that these retirees might look to, the percent that said that they would look to a credit card to either fund it or help fund it has jumped considerably. I think it went up by over 30%. So,
Michael, I think that's really interesting. Like, do you think any of this though is people who are retiring now in a higher inflation environment, in a depleted market environment, are the people who can kind of, if you will, afford to retire and are the ones without the credit card debt, or do you see like there's been a kind of a consistent increase in retirement since this?
Yeah, that's a great question, Rob. And I think we all heard the cute terms we coined all throughout the pandemic of the great resignation and the great rehire. I think there was, my gut tells me, just anecdotally looking back, I don't have any quantitative data to prove this out, that I think there was some of that selective terminating that was happening throughout the pandemic. Now that you see all these, solid numbers on growing workforce participation and lowering unemployment rates, it could be accelerating. It could be self-selection if you want to use that. So the positive ones are the ones that we're getting the signal on, and the negative ones are staying behind in the workforce. I absolutely think there could be some realism to that.
Yeah. I mean, time will tell, right?
So we mentioned housing and home equity a second ago. One of the interesting things about home equity is sometimes people, as you sort of described it, is like a break glass asset, right? Where I use it as the asset of last resort for long-term care expenses, et cetera, et cetera. But another tool that's in the toolbox is a reverse mortgage and other innovative solutions. But yet the uptake on reverse mortgages is very low, even though they could be used in somewhat sophisticated ways, right? As a way to sort of mitigate the risk of sequence of returns, or to grow the balance on your home equity in case of emergency. Any thoughts about that?
Yeah. My first comment would be, before you get to the question of a reverse mortgage, can you afford the house? If the house is too expensive and not affordable for you, you don't need to get a reverse mortgage. You need to get a less expensive house. I think that reverse mortgages definitely have a place, as you say, in a number of different. They're in a number of different situations where they can help in a strategy, and they're one of a portfolio of strategies. I mean, one is to sell and downsize, one is the reverse mortgage. So, and you may also want to go to a lower cost area, which is a different form of downsize. I think that the people who are working with people and advising them, they really need to be familiar with this strategy, this whole portfolio of strategies, and incorporate them. I think that would increase the uptake somewhat. I think there's also, though, a very negative feeling on the part of retirees about reverse mortgages and taking them. We've had some questions in some of the post-retirement risk surveys, and people they don't want to do that. They want to hold on to the value of their house. You've also got the issue that if you do take a reverse mortgage, on the one hand, you can still lose the property if you can't pay the taxes and do the. So there are a number of issues there, and if people are able to have that portfolio in front of them and evaluate those options either through an advisor or on their own, I think we would have more use. But we're not capable, and that one of the problems you have throughout. It's true about long-term care products. It's true about using housing. It's true about different methods of payout. You've got fairly complex ideas. You have different people using different words. So there's a lot of jargon. There's a lot to do to simplify things, lay them out that give the consumer a much better chance of understanding the options and choosing. Maybe some of this new software is going to help them do that.
Yeah, Anna, it's interesting. I always think about retirement, like saving for retirement is easy, but planning for living in retirement is difficult. It's complicated. It's filled with confusion, and it's filled with contradictory advice oftentimes. I know, Rob, you were just about to say something, but I had to get that in.
Yeah, no, I think you're right, Bob. I was just gonna kind of riff off of what Anna said there about like the jargon, and I do feel like sort of the language of reverse mortgage kind of has some negative tones to some people. They kind of think about maybe some of the very earliest products, and sometimes, I was talking to a retiree recently, and they were saying, "Well, I know so and so who had a reverse mortgage, and when that person died, the kids kind of had to sell the house right away. It was a big mess." So kind of like some of that, those precipitates that kind of come from just people having a bad experience or hearing those words and just kind of having a negative reaction. I think that's kind of maybe putting a bit of a hurdle to the uptake.
Yeah. I'll just jump on and add to that one and make one other point. I see it loud and clear that, the complexity of not only the language, but the product design of things like a reverse mortgage kind of puts it in the same ballpark as many discussions around annuities, right? I mean, people just don't understand them. They need the help. I don't believe that the advisor community in general is as conversant on these products as they otherwise could be. If they've got an older concentration of clientele, maybe they're on their way. So I do think that's one of the things that becomes a hurdle there is just understanding and again, simplifying language. The other two things are just so that Anna mentioned, right? You've got the downsize and you got the reload, right? I mean, I think over the years, the whole idea of the snowbirds or the reload from a cold climate to a warm climate, it's just simple to envision and understand. And so is, moving from a 4,000 square foot house to a 1,500 square foot house, right? I mean, I think those are easy to understand. But I do think I looked, and I've got to dig the data back up, even those simpler ones don't get implemented as often as people think they're going to, right? You hear all these stats that, the vast majority of people are going to move to the smaller house, maybe in the same community, or move to the 55 plus community in Florida or Arizona. But it winds up being like a third of the ones that originally say they're going to do it actually do it. I think it has an advantage because of the simpleness of the concept, but some of these products just, are still, I think, way too complex in the way they're talked about, especially reverse mortgages.
Yeah. It's interesting because I agree, reverse mortgages have that negative connotation in part because of the history, right? We had people selling them on TV. We had lots of, unsavory business practices, perhaps. But in other countries, and I can't think of the exact term, but I think in England, they don't use the term reverse mortgage. They think they use something like equity unlock or something like that. Maybe, Anna, the term. Yeah, but they're using different language to make the product seem more appealing to people. I don't know what the uptake is in those countries.
One last stat I would throw out there, Bob, just to prove how important this point is. I mentioned this earlier, but if you look at housing as a percentage cost of expenses of living, for the younger population, which I said earlier was 55 to 64, it's about 33% of their total spending. For 65 to 74-year-olds, it jumps up to just over 35%. And for 75-plus-year-olds, it's about 38%. So all three of those are the single largest category of spending that people have. So
I would like to go back to the reverse mortgages, annuities, and talk about another issue that is just a little bit, I think it's there for all of them. If you have a product where it's possible to have variations, if you have a competitive marketplace, then the different sellers have an incentive to put in bells and whistles and have different features because my product is going to be better than your product, or my product is going to work better for this situation. However, the more of that happens, the harder it is for the consumer to be able to compare things, understand what they are. And I think there's a natural tendency, and I myself, I'd say I'm the same way. If I have a decision to make and I really understand it and it's straightforward, I'm much more likely to be, okay, I'm here, let's go forward. And if I've got a decision to make and it's complex and I can't understand, how is this different? Why is one better? What's the easiest thing to do? Wait.
So you both mentioned annuities. When we were talking about topics to discuss today, annuities came up, and two topics in particular. One was the impact of inflation on retirees who might have income annuities in place and how that may reduce their standard of living given that it's a nominal payout. And also the possibility that there's maybe market demand for inflation-adjusted annuities, but they don't exist. So, Anna, you want to start?
Well, I'll start on the inflation-adjusted annuities. I don't think there's that much market demand, which is part of why they don't exist very much. I think companies have tried to sell them because while the people would like the inflation adjustment, they don't want the lower income up front. And of course, we do have Social Security is inflation indexed, and people's expenses are going down. So if they have decent, well, of course, Medicare, but they have decent medical coverage and they have some long-term care protection, it's probably okay to have annuities that aren't going up so much. And risk is expensive to insure, and people don't value that risk protection. So I'm not sure how much demand there is. It would be nice to have them, but it's definitely a challenge. And we have to think in terms of the whole annuity question. The first way, from my point of view, the first way that you buy an annuity is you claim Social Security later. Under existing law, that is a good deal. And then you need to think about the question of, should I pay off that mortgage? And then after you've paid off the mortgage and claimed Social Security later, then you may be ready to buy an annuity. And it can be a very good thing to do in a variety of portfolios. There are ways to buy annuities with attractive expense loads and attractive pricing. There are some good things to do, but it takes a lot of education for people to want to do it as part of a portfolio. The other thing we need to think about too, though, is that we're talking about a minority of the population, because you have to have enough assets. So you're not going to buy an annuity with 100%, and the people who have a very large amount of assets, they probably don't care so much, or they may use it to equal stuff out. So you're talking about a section of the population in terms of their asset level, and there's definitely more that we could be doing to help people, and there are definitely people that would benefit more.
Yeah, in the Retirement Management Advisor Certification Program, we talk about annuities for a class of people who might be constrained in the terminology of the RMA, and people for whom a guaranteed source of income to help them meet their essential expenses would be a requirement, as opposed to maybe something less stable in terms of income, like a SWIP.
And of course, the other thing, Bob, for those people is that, I'm going to go back to housing, they may need to reduce that housing cost first. And there are some easier things to do to reduce it. There's some relatively more radical things to do it, but people manage them. I mean, it's the difference. It's very interesting. The difference in the cost of housing, for example, I happen to have spent many years in Chicago, and Chicago compared to, say, Peoria, Illinois, which is not so far away, but Chicago compared to some small towns that are a few hours away, the difference in housing is so dramatic. And for a long time, Florida, there were a lot of places where you could get houses relatively very inexpensively, but they seem to have skyrocketed in Florida.
Well, I'm all for home sharing, but
well,
I would say, like, if you believe in kind of like efficient markets and supply and demand, right? If there's more discussion about inflation, we might start seeing some more inflation adjusted annuities. I mean, I think we're coming up the heels of maybe never really talking about inflation that much for the last 2 decades almost, right? And so there are products out there because people didn't have this at the forefront of their mind. But I think, Anna, you talked about, insulating against that risk. It wasn't a risk people were thinking about. And so, yeah, like Bob, what you're saying, people that are kind of constrained, those higher paid, the higher balance people, they can self-insure against that risk. But if we start seeing more volatility with inflation, particularly higher inflation, then I think we're going to start seeing probably some more products that are out there for those people that are constrained.
Yeah, I'd like to jump on that. I think Rob's on to something. I think the lack of interest in the markets, because we've been in, tripled, 30 years, 3 decades of not really talking about or worrying about inflation. Now, all of a sudden in 18 months, it's front and center. So I think if we do stay, as they're saying now on investing radio, higher for longer, if that happens, I do think we'll see a resurgence of interest. I think we'll see a little bit of product innovation that might improve it. I think the product innovation I mentioned earlier about the tools that are more integrating Social Security optimization into them, so people think about that as an extension of annuity, which is meant to cover your non-discretionary expenses. I think the more that these products get packaged and sold in that way, they will build momentum. You do have to, I think the wealthy will self-insure. The underfunded can't afford to, buy an annuity to make enough of a difference. But if you take that middle, I don't know what it is, half of the United States or 2/3 of the United States, and you start laying out discretionary versus non-discretionary and what role does Social Security play, that gap that's left, I think there's some real traction in there. And I think inflation-oriented products, my guess is if we, again, stay higher for longer, you'll see them start to fill a little bit of that gap.
Yeah, and I think about often, Anna, I think about the Society of Actuaries with its retirement risk chart, where you note 15, 16 plus retirement risks that need to be managed and mitigated. And I always think of the two big ones, right, being longevity and inflation. And yet the tools that you would use to mitigate longevity are not the same tools that you would use to mitigate inflation. And so somehow, some way, there needs to be a balance struck between managing and mitigating those two big risks, I think.
Well, that's true.
Every now and then I get to speak true words, Anna. So the other topic that we have on our plate is this notion of retirees and their children, where retirees have perhaps become the family bank because of problems that the children of retirees are facing. And there's a compulsion on the part of older, especially more wealthier retirees to help their children financially, whether it's to, help them with a down payment on a house, or help them with college education costs, or help them with special needs children, on and on and on. Where do you come down on this, Rob? Let's start with you.
I know, clearly, I mean, parents got to do a lot for their kids. I mean, we've seen a lot of this. I was just in a focus group, and I heard one retiree probably had about like maybe a $200,000 balance, just wrote a check for about $50,000 to pay for an adoption for their daughter. And that person, I mean, that was planned, right? That's a big chunk of that retiree's money. But that person said, there's nothing more I'd rather spend money on than my family, and my daughter needed this, and that's a pretty extreme example, but I for sure see it with student loans, for sure see it with other parts, just trying to help kids get their feet set with housing, kind of that down payment on the house, because the difference between renting versus owning a home can be huge. And so this almost comes back to where Michael kind of first started when he was talking about how like people are spending, and so much of that is just really kind of a mental thing, right? We're not necessarily doing what the economists say are the optimal things, but we're doing things that people are really kind of almost leading with their heart on a lot of these with parents. And so it happens. I don't have firm statistics like Michael, Anna. I don't know if either of you have like where people are actually spending their money on their kids. Do you have any data on that?
I don't, but I'm hearing loud and clear of the stories you just told, Rob, of people saying, look, if the one adage I heard was that if, you are above 18 years old and your parents are still, writing checks and helping you out. It's purely out of love, right? Because of that's a priority for that person from an expense standpoint. So who are we to say right or wrong if that gives them satisfaction? And I hear those stories a lot. I also hear from advisors, especially advisors now that are trying to marry a retirement and a wealth practice. So maybe they were doing 401k administration, but all those now, as far as I know, just about all of them are also trying to get into the wealth business and help the participants that are in the plan, both in the plan and beyond the plan. I'm hearing a lot of these requests to say, as my client base ages, and it's not just purely chasing it for building a business for the next generation. It's more of answering these questions for the current client, right? If I've got children that are challenged, they live in an expensive place and can't afford to buy a home, or they need that, a car as they graduate in college, whatever those expenses are. There's a lot of advisors that I talk to on a pretty regular basis that are saying, give me some insights to how to, kind of talk about that in a meaningful way. And it's not just the end of life bequeath, it's more of the helping in the here and now type of question.
I have a couple of sets of information about that. Actually, I believe Sudipto, who works with you, Michael, when he was at Ebury, did work with the Health and Retirement Study, and are definitely there are more transfers from retirees to adult children than from adult children to transfer. And it's not a little bit, it's a lot more financial transfers. Also, in the Society of Actuaries focus groups, one of the shocks that showed up, we did both focus groups and survey work on shocks, and there were 3 things that showed up as shocks that people couldn't recover from, and one of them was adult children that needed ongoing help, like if you had an adult disabled child or one with chronic job problems or other chronic problems. And they don't just help with down payments in a house. They help when the kids get into trouble, when they do a variety of things. I want to take a couple of different takes on this too. And I remember years ago talking to a financial advisor about mistakes, where she said one of the biggest mistakes my clients make is they're giving too much money to their kids, and it really harms them in the end. And that's a particular problem for women. And women particularly, rather than thinking about their own, how do I take care of myself, they're busy taking care of other people, and then they get to retirement age, they're widowed, and they're not taken care of. So this is a really big issue for women. I want to talk a little bit about millennials, though, in connection with this, and the whole question of what happens at the point that people reach adulthood. And when we did the generation survey and looked at financial fragility, the millennials were the most likely to be financially fragile. Well, some of them grew up at just the point of the Great Recession, and what they were faced with was a lot of student loan debt because education had gotten more expensive, and a really bad job market at the point that they were entering the job market. So you had people that went to an expensive law school and they weren't getting, law firms weren't hiring. And you had many versions of that story. Well, I don't know of a real study but I think it would be a really good thing. I think that the economic and life conditions at the point that you start out in the job market follow you through your life, and can follow you through your life. So you had people who had the high student loans, trouble getting jobs. They weren't able to afford to buy houses. They delayed getting married. So everything about their life, there's delayed retirement savings, got messed up from the conditions then. And parents were a lot helping them. That's definitely true. And I think for the parents, it's a real question of balance and longer-term thinking. And I guess that I would say the parent, on the one hand, helping them is a really good thing, but only up to a point, and not, saying it's the best thing I can do. It might be the best thing you can do now, but the price may really be too high. And that the failure to have long-term thinking about it, I think, is a big problem. So I really want to encourage advisors to be able to figure out some ways to get people to think about that longer term and evaluate that decision, especially when it comes to something like a wedding, or if it's a house, it's a question, or, is it going to be a big down payment at a big house? Maybe it needs to be a smaller house. Maybe it needs to be a smaller wedding. And there's really lack of balance, and those are things you may pay the price. We did not find in our research, by the way, in the SOA, many people buying boats and RVs. I mean, you hear stories about boats and RVs. We didn't see that. But I think in terms of children, sometimes it's a lot of money is being spent that people can't afford.
Yeah, Anna, you talked about like some shocks and things, and one thing that I'd be remiss if we didn't talk about was we're talking about kind of like family units here. It's just the increase in number of divorces we see among retirees, and I think that's a huge shock that's out there. I mean, the one thing I saw said that, like, right now, we've seen the rate of divorces among retirees be double what it was just a couple of decades ago, and it's expected to triple by the year 2030. And so, to your point, right, if people are paying a lot, like kind of early on for some of these things for their kids, well, then later on with these shocks, things that you can't plan for, like now you've depleted those assets.
Well, so divorce and retirement is one of those three shocks that the people can't.
Yeah.
We only have about 6 minutes left, but before I ask the final question, it was interesting. There was a study done by the Center for Retirement Research at Boston College where they looked at satisfaction in retirement, and they said that typically 3 factors were in play for people to be satisfied with retirement. One was that they retired on their own terms, 2, that they were in good health, and 3, that they were still married. So this divorce trend is going to create some unhappy people, I think.
Yeah.
Hey,
Bob, before you move to close, I just want to reaffirm something that I heard Anna say that I think we all ought to think about. The different decision-making criteria between men and women is significant. What they prioritize, how they think about it, thinking of others before themselves, it's all huge. And for the first time, we just did some research last year. We believe now that more U.S. wealth is actually controlled by women than men. We think that number broke 30 trillion that women are in control of. So I think we've got to think about things in a much more woman-centric way. The words we use, the way we think about things, how we prioritize it, I think it's critical for the industry.
And
Joe Coughlin at MIT is famous for saying the future is women, right?
Yeah. Also come back to what you just said about the health thing. I think health is a big issue. At the same time, I think people with limitations, there's a lot that they can do, and it's also helping them stay in as good health as they can, but also function with the limitations. I didn't hear you talk about social engagement, and I didn't hear you talk about passions. And we've increasingly come to realize that social engagement is really important for a good retirement. And I think having passions is important. And also, when you start to have limitations, support systems. So there's so much to managing life. And I think one of the big business questions for advisors is how, if I think about that client managing their life in retirement, I can say, okay, I'm going to deal with the money, or I'm going to deal with the money plus the insurance, or I'm going to deal with more issues. There are scope questions. What are the things that I'm going to help with? And if there's things I'm not going to help with, or am I going to go as far as saying, this is a problem, you need to deal with it, and by the way, here's somebody that can help you, here's a type of person that can help you. So I think today there are so many questions for advisors about how am I going to help this client, and how big is the frame that I'm going to apply to helping them? Is it going to be narrow? Is it going to be broad?
So Anna, you thankfully just sort of answered the question I didn't ask, because I was going to go into a lightning round about what advice you would give financial advisors as they think about helping their clients either plan for or live in retirement. So you've said your speech.
Yeah.
Rob, how about you? What do you?
Yeah, I mean, I would say kind of like one of the main things that we heard on this one is don't assume everything is going to be just optimizing from the brain, and certainly think about the heart and factor into some of those variables.
Right, Michael?
Yep, I think I already said it. I'd say focus on women and how they prioritize and decision make, and also think about the emotional as well as the financial and the technical.
Yeah. Well, as you all know, we could all talk about this for hours on end, and I would love to, but we have come to the end of our time together for at least this roundtable, and I want to thank you all for joining me. It's been a great pleasure, and I'm certain that everyone who listens to this or reads the transcript will benefit greatly. So thank you, Rob, Michael, and Anna. Appreciate it.
It's a pleasure. Thank you.
Thank you.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.